Hello and welcome to the Mortgage Minute Realtor Rant with your host, me, Excelman Ruben Venegas, your neighborhood realtor and senior specialist of all loans, bringing you the latest market trends and the latest real estate news. So today's topics are the federal rate reduction impact, first-time homebuyers programs, who qualifies, the new conforming loan limits, and mortgage loan types. So let's get to it. As you all know, the Federal Reserve reduced the interest rate 0.5%, and they're predicting to reduce it another 0.25%. Now, rates have been trickling down, and this is really good news. What has been the impact? Well, the impact is that we've seen an increase of about 120% in mortgage loan applications. This is creating a lot of activity in the market, and a lot of lenders are ramping up. They've slowed down some of the pricing over the last week just so that they don't get inundated, but the trickle down interest rates are coming. So like I said, good news. As rates take another dip, pre-inventory predictions for the fourth quarter as far as houses on the market is trending in the right direction. So you're gonna have more houses to choose from. You're gonna have more ability to buy and more options to buy and an easier way to get your foot in the door. So first-time home buyers. What is specifically a first-time home buyer and who qualifies? Like, what is that program? So if you don't own a house, you don't have vested interest in a property, you're not paying a mortgage, then you qualify for a first-time home buyer program. If you do own a house, but you didn't buy it in the last 12 months, you also qualify for the first-time home buyer program. So anybody that has not bought a property in the last 12 months can use the first-time home buyer program. Now, what does that mean? Well, first-time home buyer programs do down payment relief. So then you don't have to put 20% down. It's not true. A lot of people think, oh, I have to put 20% down on my first home. I have to put 20% down on my investment property. That's absolutely incorrect. You can use the first-time home buyer programs on the FHA, Federal Housing Administration program, putting 3.5% down, or conventional, putting 3 to 5%, depending on which program you qualify for. Now, what does that mean? Well, it's $3,500 for every $100,000. So on a $400,000 purchase, you're looking at $14,000 for down payment. So anybody can qualify for the first-time home buyer program, and you can have two homes at the same time, meaning you can have two FHA loans. You can have two conventional loans without having to put 20% down on either one of them, and you can have two VA loans at the same time. So yes, you can have two first-time home buyer loans at the same time as long as they're a year apart and you have extenuating circumstances. I believe that's a business call already. I have my phone out here today because we are going to be taking live calls if in fact you want to take an opportunity to discuss your scenario with me over our rant, our realtor rant today. So there is that catch. There's a guideline that says you cannot buy the home within a 50-mile radius. But there are extenuating circumstances, life-changing events that would allow you to do that, like upgrading your property, job relocation, etc., etc. In fact, I have a great story about a client here, a good friend of mine. He lives in Elk Grove. So Elk Grove, Sacramento, California. That's where I'm from. Sacramento region, Monterey, I deal trying to reconnect, finish. I deal with a lot of there was an interruption, guys, sorry. I deal with a lot of different counties around the area, Stanislaus, El Dorado, just to name a few. So Sacramento, Placer, obviously. So here, my client here in Elk Grove owned a home. He came to me and said, hey, you helped my nephew buy his house, you helped my nephew refinance, and his sister also highly recommended you. Which, by the way, guys, 95% of my business is referral business. So I do a great job for you. You refer people to me. Your cousin, your sister, your aunt, your brother, your coworker, your boyfriend, your girlfriend, anybody that you think that may need the opportunity to want to discuss and have a free consultation to get their plan of action going from point A, I want to buy a house, to point B, I bought my house and I did it with Ruben's help, then please feel free. Give them my contact information, have them reach out. I have no problem discussing any particular scenario, because doing an analysis and doing an evaluation allows me and or a good loan officer to structure your file in a way that makes sense, and oftentimes alleviates a lot of stress, and it gives you a clear sense of direction where you're headed. So this guy reached out to me, said, you're highly recommended. Can you please help me? I need to refinance my house, pull $50,000 out. He wanted to remodel the property. He pulled the 50 grand out, got him a good refinance. And then what happened was he reached out to me again a couple days later, said, hey, Ruben, thank you for helping me on this refinance, but the truth is I need this $50,000 because me and my wife are going through it. And it doesn't look like our relationship is going to make it. We're leaning towards divorce. We're going to try to stay friends, but I want to stay in Elk Grove. And I want to continue to take my kids to soccer and be a part of the pickups and drop-offs. And I understand that more than anybody. Then I said, yeah, no, you have a life-changing event which bypasses the 50-mile rule. He had an FHA loan on his first house, and he had spoke to 4 or 5 different loan officers that told him you can't get another FHA loan because you have an owner-occupied FHA loan, and you can't live in Elk Grove because it's too close within the 50-mile radius. We wrote a letter of explanation explaining that there's a divorce, that he has to stay around for his kids, has to be close to his job, and we got him a house here in Elk Grove, 16 miles away from his current property, on an FHA loan, using the first-time homebuyer program. So, guys, make sure you have a good loan officer that knows the guidelines, knows the ins and outs of being able to qualify for these first-time homebuyer programs. So, the new conforming loan limits. The new conforming loan limits per county, per unit, are now $766 versus the old $675. They're now in effect. What does that mean specifically? Well, each county, like Sacramento, El Dorado, Placer, around this area, and each county in California has its own loan limit. So the loan limits have been increased, and this keeps you out of the high balance and jumbo pricing, higher interest rates, harder guidelines, and more criteria, allowing buyers in that 670, 700 range to continue to see the benefits of conventional and conforming pricing. So you're getting more bang for your buck. It's just another stimulus by our banking institute to allow people to create an opportunity to become homeowners. So this is a huge break. The new conforming loan limits just continue to add benefits and keep you in a structured loan program that has lower interest rates, less guideline requirements, and higher LTV possibilities. So in this next segment of this show today, I'm going to be talking about loan types. While I do that, if you have a question, you have a concern, you want to address a specific topic, please feel free to reach out to me live right now. I'll take your call. We'll talk about your program. I'll price your loan. I'll tell you if you I'll pre-qualify you on the spot. 916-206-9616. 916-206-9616. Feel free to reach out. I'm going into the loan types. So I'm going to be talking about conventional and conforming. So what is a conventional loan? Well, a conventional loan, all that really is a 30-year fixed mortgage. It falls within the conforming parameters. As I was discussing about conforming loan limits, conforming means it meets all the criteria of Fannie Mae and Freddie Mac guidelines, the loan limits, and per county requirements. So you're just in a box, everything's perfect, you're allowed to qualify for that. No ifs, ands, or buts, super smooth and easy cookie cutter files. Now, government loans have a few different programs. So we're talking about the FHA, the VA, and the USDA. FHA, Federal Housing Administration, which often comes with mortgage insurance premiums, versus conventional loans who also have private mortgage insurance, PMI. So private mortgage insurance is only required when your loan to value or you're borrowing over 80% of the purchase price. Now, if you're borrowing over 80%, you're going to get hit with private mortgage insurance, but it can be removed once you're back at 80% LTV, once there's enough equity increase. And once you've paid the loan down enough, the gap that expands there is going to allow you to get rid of that mortgage insurance without having to refinance. Now on FHA, Federal Housing Administration loans, generally a 30-year fixed, similar to a conforming or a conventional loan. However, there is an upfront mortgage insurance premium, and there's monthly mortgage insurance installments for the life of the loan, regardless of the loan to value. So in order to get rid of mortgage insurance on an FHA loan, you have to refinance out of it. So FHA is a wonderful product. It only requires 3.5% down. Conventional is 3 to 5, depending on what you qualify for. Both are going to come with mortgage insurance at that 80% threshold. FHA for the life of the loan. You got to remember those two different points. Now VA loans are super nice. Love our veterans. You've got 100% financing, which means no down payment, but you also don't have mortgage insurance. So that's a huge benefit to you when you don't have mortgage insurance. But nothing in America is free, so it does come with a VA funding fee, similar to an FHA upfront mortgage insurance premium, which, by the way, they're both built into your loan. So it's not going to come out of pocket, it's not a cost, but out of pocket cost, but it will be built into your loan. It is 1.75 of the purchase price, which generally is about, a few $1,000s being added to your loan. And that's getting a VA loan with no down payment, no mortgage insurance. It's a great trade-off. I've never had anybody complain about their VA funding fee. It does go to the VA in order to be able to promote and maintain their programs. So lastly, for the government loans, you're talking about USDA, United States Department of Agriculture. And now these also come with no down payment, no mortgage insurance, which is super awesome, but it is a rural area product. So you do have to run it through the system to make sure that the property you're selecting meets USDA requirements. And there is income limits for this program. So depending on how much money you make, you may or may not qualify. So there's a couple of hurdles there, but nonetheless, these programs are available. They're readily available, and it's something that you can take advantage of. So if you want to give me a call, 916-206-9616, 916-206-9616. I can price out your loan right now on the spot. I can answer any question that you'd like to, or program or topic that you'd like to discuss. The last bit of programs that I'll go into are non-conforming. They're non-QM. They're non-qualifying for conforming guidelines. So these kind of programs are bank statement programs and profit and loss statement programs, which is has to do with self-employed borrowers oftentimes, but it doesn't necessarily mean you have to have a business. It could be business or personal bank statements. Now, depending on how many bank statements we're providing, that's going to improve the terms and details of your loan, like higher interest rates versus lower interest rates, like interest-only options, like being able to have flexibility within the terms. So 3 months, 6 months, 12 months, 24-month bank statement programs are all readily available and generally are super easy to close. So they usually take the deposits in your bank statements. There's a bank statement calculator that we use to determine your income based off of the deposits that you're making. Lastly, I'll go into DSCR, which is debt service coverage ratio. And that sounds like a lot, but it really just is a non-occupying purchase, and the rent is being compared on a one-to-one correspondent with your payment. So if the rent covers the payment, you're going to be good to go with prime rates on the DSCR program. If the rent does not cover the payment, it's in entirety, there are costs and adjustments to the program, but you're still able to purchase the property without having to have any income or employment information disclosed. It's strictly based off of the rent being paid for the purchase. So it is on a non-occupying co-borrower. Just the same, if you want to live in the property and do a no income, no employment type of loan where you're using this kind of a program, it's called My Community Program. So My Community Program allows you to live in the property and not have to show income, not have to show any employment information, as long as you have a 20% down on a purchase and or you restrict your refinance under 80%. It does come with a reserve requirement, which means if your payment's $3,000, you need 12 months of reserves. 3 times 12 is 36. You need to have $36,000 in reserves in your account, a 401k. You can have the money gifted to you. It doesn't have to be seasoned. It doesn't have to be in your account for 3-6 months. You can deposit it within a 30-day period as long as the deposits are less than 10% of the overall purchase price, which means they are super flexible about how your reserves are being presented. This is a no-brainer for someone that's self-employed, for someone that doesn't necessarily want to disclose all their business or income information, or just can't because you don't have the standard W-2 job, but you have the money in the bank or your house is there and you want to restructure, pull some money out, use My Community. You don't have to lie about not being in your home, and so on and so forth. This last program hits a little bit hard. It's the ITIN program, the Individual Tax Identification Number. So the ITIN program is you get your ITIN number through the IRS, and these are people that are not citizens. They're not residents. They're not permanent residents. they're considered illegal aliens or non-resident pillars of the community often, because they could be, your youth group coordinator, your pastor at the church, and they have their job established, they're paying taxes, they're here in the community, really contributing, but they're not citizens. So the I-10 program just requires that 20%, maybe even as little as 15% down, and you can get your foot in the door by being able to purchase. So this is a program that over the last 20 years, I've had to reject people time and time again, saying, sorry, you're not a citizen, I can't help you. Now, whether you're self-employed, a W-2 employee, as long as you're filing your taxes with your I-10 over the last 2 years, and even if you have credit scores or no credit scores, we can figure out how to get your foot in the door with a 20% down payment. Now, if you don't have no credit scores, they may ask you for 25% down, but nonetheless, it's a way to get your foot in the door. So what loan program works for you if you're in the market for buying a house? Well, having that analysis done by a true expert, a loan officer that is able to structure your loan to make sense, is the most important part of this whole process, because it alleviates a lot of headaches and it makes you really competitive in the market when you're making an offer. I'll give you guys a prime example. I met this guy in 2023 and he said, hey, my pastor referred me to you, asked me why I haven't bought my house. I've been working on trying to buy my house for the last 16 months and I just keep getting outbid. It's super frustrating. We've lost, we keep offering closing costs, this, that, and the other, and we keep getting outbid. I said, well, what are your parameters? What are you trying to do? There are two goals where to skip mortgage insurance and to keep their payment under $3,000. So it made it difficult for them because they were tight on money, having to give that 20% down. They didn't feel comfortable with more than $3,000 payment because they just gave all their money to the down payment. So that made a lot of sense to me. I quickly just asked them, what do you think about a lender paid mortgage insurance program? You don't have to give 20%. His eyes popped out of his head because he's like, what are you talking about? I've talked to 5 different lenders. I have to give 20% in order to avoid mortgage insurance. I said, no, you don't. You can give 15%, sometimes even 10%, depending on your credit score. And we settled on a 15% down payment lender paid mortgage insurance, which means you're buying out the mortgage insurance by taking an extra quarter, even 0.5% to the interest rate, which does increase your payment slightly. But it's way better than paying another $350 in mortgage insurance. Now he had an extra 5%, a nice juicy 5% that I was giving him back from his 20% to put away in his savings. Now that was $20,000. His wife was so much more comfortable when I told him, hey, your $3,000 payment is a dream. You're gonna be paying $3,200, maybe $3,300, especially for the house that you want. But now that you don't have mortgage insurance, now that you're only giving 15%, we freed up this 20 grand to help you alleviate the payment installments over the next couple years while you settle in, while you're not married to this loan. So rates go down, you can refinance and go down to a $3,000 payment. They loved it. In 45 days, we secured a property with a contract. I represented them as a realtor. I represented them as their loan officer, and we closed their loan. It was a beautiful transaction. He couldn't believe his eyes. I got them what they needed. So that was a good example of how structuring your loan by your loan officer could have alleviated 18 months of hunting for a house with the parameters that they had. It was pretty specific, pretty easy. I'm going to have you call me right now, 916-206-9616. 916-206-9616. You can reach out to me. I'll go over any details on any specific loan that you have. I do have a text message. Can I talk to you privately after you? Yes, absolutely. If you want to talk to me privately, please don't hesitate. Text me, reach out. I'll call you after the fact. I'm just giving you an opportunity to maybe ask a question now if you're interested. Otherwise, it's okay. You can reach me at a different time. That's not a problem. So these are all the different loan types. There's about another 15 loan types that we could go into, but those are not the popular loan types. So once we discuss your personal scenario, if it makes sense, that would be something that I would look to and appreciate to structure to get you into your next real estate adventure, whether it be a portfolio loan, you're building your portfolio, or you're looking for an investment property, and or purchasing your first house. So this was my realtor rant for the day. Please don't hesitate to reach out. Have any questions, comments, or concerns? Thank you so much. Over the last 20 years, I've appreciated talking with you all. I appreciated your referrals, and I appreciate your business. I'm Excelman Ruben Venegas, your neighborhood realtor and senior loan specialist of all loans. This was Realtor Rant, the Mortgage Minute. Thank you.